behind it, and that they have the quality that iShares stands behind.
So Daniel, is that a yes? Is that a maybe? Is that a no?
There's areas of the market that we haven't gone for various reasons, and we think about building better portfolios. We take stock in sort of investor outcomes and expectations when it comes to product innovation.
Are you worried at all about what some of these products are doing to the market? There has been a flush of retail interest into what had traditionally been considered pretty risky products, right? Is this a good thing for the market because of investor education, or is it a bad thing because people are taking on undue risk?
No, you really hit the nail on the head. Ultimately, this comes back to investor education and understanding what you own. We do believe in the democracy of investing and making investing more accessible, but we strongly believe that investors need to understand what they're owning and understanding the risks that they're taking inside their portfolios.
All right, Daniel, really great to speak with you on this Friday. Have a great weekend when you get there. That is Daniel Prince of BlackRock. Tune into ETF IQ on Mondays at 12 p.m. New York time. And you can read all about the ETF industry in my weekly newsletter. That is Bloomberg.com/ETF IQ newsletter. But let's bring you some breaking news right now. This coming from President Trump speaking to reporters at the White House. He is due to depart to Texas today. He says that they are treating former Brazilian President Bolsonaro very unfairly. Some comments about Fed Chair Jerome Powell as well. He is saying that Powell is doing a terrible job. We have heard that before, and we will continue to follow that. Just quick remarks to reporters at the White House.
Yeah, and we should say that his remarks are sending the Brazilian real lower. So interesting cross-asset moves on the heels of this dispute, perhaps the most intense between the U.S. and Brazil, being seen as the most intense besides China.
Yeah,
basically.
Exactly. And a real expansion of how this administration is using tariffs. We'll continue to follow that. But coming up in the next hour, Cameron Dawson of New Edge Wealth joins us, as well as Bess Friedman of Brown Harris Stevens. This is Open Interest.
Bloomberg.
And we are 30 minutes into the trading day, and we are in apparently the dog days of summer. We have the S&P 500 down about 0.4% on the day. We are off of session lows, but lower nonetheless, with most major sectors in the red. The Nasdaq 100 also down 0.2%. That 10-year yield back at 4.4%.
Yeah, there you go. It just feels glued to that range as we keep talking about. I will say, it doesn't feel like there's much conviction behind this selling that we're seeing. Volume very much below its 20-day average on this Friday morning.
Right. It is a Friday after all. Welcome back to Bloomberg Open Interest. I'm Sonali Basak.
And I'm Katie Greifeld. Matt Miller is out of the country.
And some reasons you might be saying some tough stuff in the market. Another day, another tariff. Remember President Trump announcing a 35% levy on Canada.
And that's why you have stocks pulling back from record highs, with earnings season set to kick off next week.
And big banks leading that earnings parade. They are set to post gains thanks to record trading days after President Trump's tariff announcements.
Yeah, and let's talk about that, because the president says that he is eyeing blanket tariffs on most trading partners. We know that he's singled out Canada in particular, and in a letter posted to Truth Social, he threatened a 35% rate on some Canadian goods. Now, for his part, you have Prime Minister Mark Carney responding, saying that Canadian governments will defend its workers and its businesses. So let's break it down now with Bloomberg Washington correspondent Tyler Kendall. Tyler, great to have you with us. Actually, just in the past few minutes, we heard from the president himself, of course, speaking to reporters at the White House. We know that he's heading to Texas today, and he had a lot to say about Brazil's former president.
Right, exactly, Katie. He's really doubling down on this idea that he's going to link these tariffs to what he says is unfair treatment of Brazil's former president, Bolsonaro. It's an interesting dynamic here when it comes to imposing on Brazil what would be a threatened 50% tariff. We're talking about the baseline tariffs going up. Brazil had been facing a 10% one. Now President Trump is threatening the global blanket tariffs higher and Brazil's tariffs even higher. But keep in mind, these reciprocal tariff plans are based on the International Emergency Economic Powers Act, IEPA, which is supposed to be justified by this idea of persistent trade imbalances. But instead, President Trump is using the justification here to tie it really back into politics. It's an interesting development, as President Trump really does seem to be ramping up his tariff threats and not really backing down if we look at sort of all the different factors that have emerged just this past week, holding firm on the August 1st deadline, ramping up tariffs on Brazil, on Canada, and also making sure that those sector-specific tariffs are still coming down the pipe as well.
Tyler, we thank you for keeping an eye on all of it for us. That is Bloomberg's Tyler Kendall. And joining us now, Cameron Dawson, Chief Investment Officer of New Edge Wealth. And you look at the new tariff strategy that the president is putting forward. What struck me as well is the 15 to 20% tariff rate that he is considering on most major trading partners. 20%, Cameron, seems to be higher than most investors that we talk to are expecting. What would that mean if we get that high?
Yeah, we think that there's a fair amount of complacency amongst investors when it comes to the impact of tariffs on the economy and on markets, simply because there hasn't been any impact to the data yet. If people are looking at the last couple of months, they'd say, look, we've seen a little bit of an uptick in continuing jobless claims. Inflation hasn't ticked up that much, but things like retail sales have really held up. So there really isn't all too much impact from tariffs. However, we think it's probably too soon to make that judgment that a lot of these things are going to take time to work their way through markets. And we heard that from Levi's this morning. Effectively, they're saying that sales are holding up, but they're taking the hit on gross margins, which suggests that if you look at the tariff revenue that's been raised thus far, it's about $100 billion. It may be company margins that really bear the brunt of paying for the cost of those tariffs. But that, again, will take time to work its way through.
Yeah, it's a good point, too. And we actually heard from St. Louis Fed President Alberto Musalem yesterday saying pretty much the same thing, that it's too soon to know the inflation impact of tariffs. So still in a wait and see mode, even if it seems like the broader market doesn't think so. But with that in mind, Cameron, I mean, where do you pick and choose your spots in this market?
Yeah, we certainly want to stay in the higher quality echelons of this market. One of the most interesting things coming out of the April low has been that it has been led by low quality, high beta, very liquidity sensitive portions of the market. And those have absolutely ripped higher. They've returned 40, 50% coming off of the April lows. But what we think is that as you start to see some of the economic and real earnings impact work its way through, this is a great reminder to really focus on companies that have a strong track record of blocking and tackling through uncertainty, looking at companies with strong balance sheets as well, and that resilience in free cash flow generation. So we wouldn't be chasing the low quality, high beta rally. We'd be sticking with the high quality parts of the market.
There seems to be a lot of complacency out there. You've just mentioned it yourself. And one thing that's interesting is that if you look this morning, you had S&P Global Markets come out with a note saying that there has actually been the highest pace of bankruptcies since 2010. And you wouldn't know that by looking at the stock market. So is there some pain under the surface that people are not accounting for?
Yeah, and here we are sitting with triple B and double B spreads, high yield spreads at their tights for the year, suggesting that complacency is not just in equity markets trading at 22.4 times forward, but it's also within fixed income markets. And we think that that really is a function of being in an abundant liquidity environment with so much money sloshing around chasing an ever dwindling supply of things like high yield bonds or high quality stocks. You've seen this upward pressure on valuations that's hard to beat. And the other aspect of this is that you still have a fair amount of equity investors, a big cohort that remain underweight equities, with the Deutsche Bank Consolidated Positioning Report still just at 30%. So even though you are seeing these risks start to bubble up, even though you're starting to see signs of financial stress, people being underweight markets suggests that they're having a willingness to look through it. And we think that volatility will kick back in once people get fully invested and then look around and say, well, do I really want to pay this valuation for this degree of risk?
Let's continue on with this idea of corporate credit, because you mentioned these very tight spreads. And you're right. If you take a look over a 1 year, a 5 year basis, we are very tight when it comes to blue chip, when it comes to high yield. There was a really interesting conversation on Bloomberg Surveillance earlier this week with Amanda Lynham of BlackRock. And her view was actually that there's a risk that people are being too defensive, that the risk is actually that folks aren't positioned for enough risk, a risk-on move. It sounds like you're taking the other side of that argument.
Yeah, we moved to be underweight high yield earlier in the year, and it was the wrong move, meaning that you've still seen this ever pressure down on high yield spreads. And what we see is that investors look at high yield or look at investment grade credit overall and say the all-in yield is still very attractive, even if the spread is very tight. And the other aspect that you have is that credit issuance has also been really light. So companies have been trying to kick the can down the road, defer their issuance because of higher yields, which means that there's a very little supply of incremental credit. So you're in a world where demand is high because all-in yields are high, but supply is low, and thus we continuously get this downward pressure on spreads. The thing to note is that the volatility to the upside is very episodic, which means that once people start getting afraid of growth, you see a very sharp move higher in spreads, but that is typically a very good buying opportunity to step in and take advantage of those higher yields.
Speaking of higher yields, we have seen the 10-year drift back to 4.4%. And Katie had cited a note from DoubleLine earlier in the year that proved to be very, very prescient. This idea that investors might prefer owning Microsoft bonds over U.S. government bonds. And so far, you've seen a lot of investors seeking safety in the corporate bond market relative to the government bond market. What does this tell you about risk appetite?
Certainly, the full faith and credit of the Azure cloud versus the U.S. Treasury. Look, I think that there is still this underlying concern, and you see it not just in the U.S., but around the globe, of the upward pressure on long duration, long end yields, which suggests that there is some concern about sticky inflation, as well as questions about high deficits drifting higher around the world. And so we do think that bonds play somewhat somewhat of a different role in portfolios in this world of higher inflation and higher deficits compared to the last 40 years of being in a big bond bull market where you could count on yields drifting ever lower, which means that maybe isolating credit risk, as you say, preferring to have the full faith and credit of Microsoft versus the US Treasury seems to be what people are leaning towards.
Yeah, Microsoft, it may not have taxing authority, but boy, like you said, it does have the cloud. Cameron, always great to speak with you. That is Cameron Dawson of New Edge Wealth. Let's take a look at some of the single stocks moving this hour. We're just about 40 minutes into the Friday trade. We'll do that with cross-asset reporter Denitsa Sekova. And NVIDIA, top of mind for investors after hitting $4 trillion. What's it doing today?
It's actually up. In earlier trading, a lot of the Magnificent Seven, actually all seven, were down. And what we're seeing today, which kind of makes sense with the overall market reaction, is resiliency. And NVIDIA is up more than 1%. Amazon is up. For example, Meta is seeing a lot of pressure, but of course this is coming after a meteoric rise in the last couple of months. But Magnificent Seven has a very different reaction now to this flurry of tariff headlines we've seen than it had in April. We're seeing all those indices of policy uncertainty showing increase in uncertainty, but indeed Magnificent Seven is continuing to be strong. NVIDIA obviously above $4 trillion. We had that meeting with President Trump. Jensen Huang is going to China now. So there is a lot of optimism, and I think what's prevailing in cross-asset right now is not missing the rally. And we saw President Trump tweeting yesterday, Nasdaq at records, industry at records, crypto soaring, and NVIDIA at records.
It's funny. I'm glad you mentioned Amazon as well, because yes, it's one of 4 stocks in the S&P Consumer Discretionary Index that's higher today. The other one that's only higher than that, I just think this is really fun, is McDonald's. And so go figure, you have a market that is sussing out fresh trades. We're keeping an eye today also on cryptocurrencies. You have seen a pretty stunning rise in Bitcoin once again. Coinbase seems to be a big beneficiary.
Incredible rise. Bitcoin is a record high. Clearly, there is no risk of positioning today. We're back. Magnificent Seven is back flat on the day. Bitcoin is at 118,000. We're seeing all those companies, Mara, Riot, Coinbase, rising. We're seeing a lot of support in Washington. They actually just declared the next week as Crypto Week.
Oh.
We had the stable coin.
Not Infrastructure Week? Did that ever happen?
No. It's Crypto Week.
You could consider crypto infrastructure, depending on
Yeah, I don't know if I can build a road out of Bitcoins, but Crypto Week next week.
I think it's a sign of the times, right? We have that stablecoin legislation. We have a lot of support in Washington. At the same time, we have institutional investors becoming more bullish on that. We actually had one of the biggest inflows in Bitcoin ETFs as well. So we have retail, institution, and DC. And that kind of explains why some of the biggest winners today is crypto stocks.
But you know, just real quick on that, Circle is actually down today, though, on stablecoins because of yet another downgrade.
Circle, it's still up so mightily from its IPO. Let's move from crypto to drones, because also in focus this morning.
Yeah, everything today is moving off news of the administration. We have the Defense Secretary issuing orders to ramp up productions and deployment of drones. Obviously, that's something that President Trump has been talking about a very long time. It's been one of the big trades. For example, I'm looking at Red Cat today. It's up 20%. That's actually one drone company that was down year to date, so it makes sense that it's leading the rally. We're seeing that kind of reversal. But pretty much everyone in the space is seeing a really big gain today. And if you look at the BlackRock Aerospace and Defense ETF, it's up 30% year to date. So clearly one theme that has been a reliable win for investors. And whenever we get news like that, you can see a lot of retail sentiment really shifting very rapidly there, and a lot of bullish options.
Red Cat, activity. Is that a Katie kind of stock?
Yeah, I was thinking about it.
I like cats. I don't know how I feel about drones. I will note it's a pretty small company, less than $800 million in market cap, but having a great day.
Having a great day. There's somebody else having a great day. I will talk about it in just a second. Denitsa, thank you so very much. That is Denitsa Sekova of Bloomberg News. Ken Griffin's good day. Ken Griffin Citadel Securities expands its dominance in market making. We're going to talk about what's happening at the market making firm next in the Wall Street Beat. This is Bloomberg Open Interest. And now to high interest, a look at what's making headlines around the world. President Trump says he's planning a major statement on Russia on Monday. This is as the U.S. prepares to send more weapons to Ukraine via purchases from NATO allies. In an interview on NBC, Trump criticized Russian President Vladimir Putin over Russia's continued attacks on Ukraine. And Bloomberg has learned that Performance Food Group has attracted takeover interest from U.S. Foods. A potential deal would create a food distribution giant company with combined sales about $100 billion. M&A just taking off. And Treasury Secretary Scott Bessent told a room full of billionaires in Sun Valley that President Trump shares a personality trait with his former boss, the famously liberal financier George Soros. Both men, he says, are impatient when working on high-stakes deals. And Citadel Securities bought the unit of Morgan Stanley that's focused on electronic market making for U.S. equity options. It's a move that further cements the firm's dominant role in popular derivatives, and that is today's focus on the Wall Street beat. We're going to dive into this now with Sridhar Natarajan of Bloomberg News, and it is amazing to see Morgan Stanley sell this business to Citadel Securities. Why would they? Because their rivalry is very, very fierce between Citadel Securities and the big banks. What does Morgan Stanley gain from handing it over to Ken Griffin?
And look, it's interesting that you take that perspective, because the question in my head was I couldn't believe Morgan Stanley was still in this business, and that was borne out in the story, because apparently Morgan Stanley was the last big bank still in the business of electronic market making of U.S. equity options. The thing you have to think about, and when you zoom out a little bit, is when you think about the equities business on Wall Street, with the big banks, it's intermediation and financing. Financing is the pocket that's been growing. Financing has been the pocket that's been lucrative when you leverage up your biggest clients so that they can make big bets in the market. Intermediation has not been seen as a high return business. It's more a good value proposition. It's something you need to have for your institutional clients to be a full service player. And when it comes to markets such as US equity options, especially where there's so much retail trading interest, that's built for speed and scale. That's built for players like Citadel Securities and others with specialized technologies. Banks like Morgan Stanley are not in a good position to compete. So, and once they're pulling out of that space, it's not a surprise that it's Citadel Securities that swoops in and takes those positions.
Shri, I'm comforted to hear you say that, because when I got the push alert on my phone yesterday, that was my reaction. I didn't know that Morgan Stanley was even in this business. And according to Bloomberg Intelligence, they only accounted for around 6% of such payments, which is also a little bit surprising. So now that we have the big banks fully out of this space, talk to us a little bit about the competitive landscape. Obviously, Citadel Securities is the big kahuna there, but what does the rest of the leaderboard look like?
And if you expand beyond just equities, fixed income, you look at players like Citadel Securities and the Jane Streets of the world, IMCs, they are making a bigger move into the traditional space of the big banks, and banks really don't have much of an option. These firms are not tied down by the same kind of regulatory constraints. They have invested a lot in their technology. They can do a lot more with a lot less. Look at the banking infrastructure, the number of people you have, the number of operations people you have to have, and then the regulation and compliance focused people you have. These competitors don't have those headaches.
I want to throw you a curveball, because next week is bank earnings. Goldman Sachs is expected to come out with the highest amount in equity trading revenue. Of course, obviously, we've been talking about Citadel Securities and the competitive nature of it, but there's also all this headline risk around Jane Street. How is the rat race shaping up this summer?
Well, the Jane Street headline risk, at least, it's not so much as to how it affects the rat race, but it is the gloating behind the scenes that you see, not just from the biggest banks, but also the other direct competitors to Jane Street. That's a problem they'll have to solve for. Again, we're talking about the options market. The fact that the options market in India accounts for 80% of the global volumes, that's just a crazy stat that a lot of people didn't appreciate, and it had become a lucrative space for a lot of players. Jane Street will have to figure out how to navigate it. The regulatory landscape in places like India isn't necessarily as predictable as what they're used to in India. And yes, it'll be a bit of a stumble, and the competitors will be happy for it for now. But I don't know if that necessarily changes in the long-term secular trend of where these players have been dominating and have been making inroads.
Yeah, that temporary trading ban for Jane Street in India, I have to imagine that hurts, both from profit making and also reputationally as well. Sridhar, you have a busy week next week. You and Janali both with bank earnings. So God bless the both of you. That is Bloomberg Sridhar Natarajan. Let's get a check on these equity markets right now because the S&P 500, we're off our worst levels of the section. We're not quite back to positive territory, but the NASDAQ 100, it's gunning for a green day. We'll see if it gets there. Meanwhile, you take a look at the bond market right now. A bit of a sell-off underway when it comes to the long end of the yield curve, currently up about 5 basis points. We'll check deeper into markets next. This is Open Interest.
Now let's get a check on the stock market right now because it has been a really choppy trade under the surface. Of course, there's been headline risk when it comes to the Trump administration and their trade policies, and you are seeing it drag down the likes of Meta Platforms, which we know has been a high flyer this year, but it is the biggest points loser on the day. Same goes for Berkshire Hathaway, Broadcom, Visa, JP Morgan, also down ahead of next week's bank earnings. Now, on the upside, you do have NVIDIA hitting new intraday highs today. Amazing since it's already hit that $4 trillion valuation mark, but Amazon also higher. Remember, this was Prime Week, and there were some worries, but now we are back on the upside. General Electric, Palantir also higher, contributing to the points on the upside on the day. Let's look at sectors, shall we? Because energy is higher on the day as well, about 0.2% higher. Information technology and consumer discretionary. I've been having a little fun here. This is not only Amazon higher, it's also McDonald's higher, but of course we are trading kind of flat on that sector. Materials, healthcare, financials, all lower. Real estate also lower. Remember, yields are higher. The 10-year hitting 4.4% once again. That draws a little worry about these financials ahead of next week's earnings. And coming up next, the New York mayoral race is heating up. You might have been paying some attention. We're going to take a look at the impacts the winner will have on the real estate market with Bess Friedman, Brown Harris Stevens CEO. She joins us next. This is Open Interest.
I met with 250 of the 700,000 small property owners. Can you imagine telling a small property owner that you can never raise the rent so that your rent rolls no longer equal the repairs of the building? Those small property owners are going to lose their property. All of these different communities are now waking up and realizing what his policies would do to them individually.
That was New York City Mayor Eric Adams speaking to Bloomberg yesterday. And on that topic, Bess Friedman of Brown Harris Stevens says that there is new stress in the New York real estate market after Zohran Mamdani's primary win, saying, quote, his proposals, such as a citywide rent freeze and ambitious affordable housing targets, have been met with skepticism. Bess Friedman, I'm pleased to say, joins us now. Brown Harris Stevens is a luxury real estate brokerage in the New York metro area and South Florida. Bess, great to see you.
Nice to see you, ladies. Good morning.
So skepticism, I feel like that's a diplomatic way to put it, because we've certainly seen responses from all over the spectrum, especially when it comes to some of the real estate proposals. So take us into your world and the conversations you and your peers have been having.
I think it's consistent with what Mayor Adams said. There's real concern about rent freezes, free bus rides. I think he had some sort of rhetoric about defunding the police early on. And I have to believe that he has good intentions, but the consequences would be so detrimental to a city like New York that is just finally recovering from COVID. Remember, 5 years ago, crime was up, homelessness, there were encampments, tourism was way down, people felt a sense of danger, people weren't going into the offices. That has all changed. We had 64 million tourists last year. People are back in the city. You know, things are better than they were before. And to have someone with these sorts of policies, I think it's like ideological mishigas. You know, it's like chaos. He doesn't understand how the city works, and he doesn't understand that we're a business too. We're a community, and we have to work together.
You know, one thing that seems to be capturing the hearts and minds of New Yorkers is just that strong focus on housing, because of course you're having rents hitting another record, more increases are on its way in rent prices. But you listen to his actual policies, some of them for Wall Street's purposes are very scary, like rent increases, or rent caps, sorry.
Yes, rent caps.
But there are other policies like deregulation, like tearing down red tape, that seem to be things that people could very much get on board with. What do you think is the viability of him to do that should he become mayor?
It's, you know, it's wonderful, like, to pretend you're a Robin Hood and you can just wave a wand and do that, but it doesn't work that way. I mean, a lot of landlords are sort of, they have this negative connotation like they're bad, but there's a lot of people who have a few buildings that are paying their bills, and something like a rent freeze would be so damaging to them that they wouldn't be able to pay their bills and make repairs. And I don't think what Mamdani is saying he would do is even possible. I don't think he would be able to do the things he proposes, but it sounds good to people because they're desperate. And as you said, rents are at an all-time high, partially because they've gone up since June 11th, something like 15%. And part of that is due to bad regulation, bad legislation. The city council passed something called the FAIR Act, which we've seen a jump in rents, and we warned them about that. But people are so insistent that they know better, they're not listening to their communities. And that's what we need to do better in New York, is come together and talk to each other so we can give expertise and help so we come up with good solutions.
Well, we have to see the outcome of this election, and we know that proposals don't often turn into policies, so we'll have to follow that connection as well. But putting that aside, if you can, I mean, if you take a look at the underlying market right now, we talked about rents, but how does it look when it comes to the purchasing market right now, when it comes to list prices? Have we seen any softening there?
I mean, every time I come here, I want to come in with some great news and be like, guys, everything is better. But, you know, it's not. Prices have continued to go up. I think this is the 23rd month that prices have gone up. Rates have not come down. I think the 30-year is now hitting 7%. Inventory is still tight in many places. So buying a new home, a first-time home, has become almost unattainable for first-time home buyers. So I wish I had better news for you, but I don't. And I think we need to solve the affordability crisis in the United States of America. New York is different because it's discretionary, but the rest of the country, people want to have a first-time home, and we need to make that possible for people.
So we've seen this particular story before. When things get a little tougher in New York, or it looks like it's going to be less business friendly, then you have a group of people that say we're leaving.
Yeah.
And some do, but for the most part, they're crying wolf.
Yeah.
Right? I mean,
people said that when, Donald Trump became the president that they were going to leave, and they didn't leave the United States. And people are saying that if Mamdani gets in as mayor, they're going to leave. I'm really skeptical about that. I think this is the greatest city in the world. It's singular in what it does. It's the talent capital of the world. And he can't just enact these policies. He has to work together with people. He has to work with Governor Hochul. He has to work with everyone. And so I'll sit down with him if he becomes the mayor, and I will try to help him to solve problems. The world is not going to, disrupt in New York. It will work together. And I don't think people are going to run out and leave. We've already had that problem because of taxes, because of so many other issues. COVID, people left. But this is New York City. People want to be here.
I want to talk about myself a little bit. I actually just left New York City, and I moved to Hoboken. I feel like I always update you on this.
Hey, I did too, so I can't even, Yeah.
I get it. It's unaffordable because it becomes unaffordable.
Exactly. Saving thousands of dollars just by going over the river. That's between rent and parking. But I want to talk a little bit about pocket listings because we signed a 12-month lease. I would love to buy in New Jersey, but inventory is so tight right now. And I've had many people tell me you need to get in with an agent. You need to get a broker because pocket listings are how it's happening, that these houses aren't even hitting the market.
That's
Have
horrible.
you seen that?
Yeah, I mean, we have that. There's this new thing that some brokerages have created, which is called a private listing network. And they're sort of, as Ray, I can't remember his last name, but he championed this phrase where he said, you can't pretend to be the champion of the consumers and gatekeep listings. And so there's this private listing network that sort of keeps the listings in and prevents consumers from seeing everything. And I think that's really damaging to the marketplace. As we know, let me ask you, where do you start your search if you're looking for a listing?
I check the Zillow app religiously.
Yeah,
so Zillow has 2.5 billion visitors a year and growing. And unfortunately for brokerages, they kind of lost this battle. I mean, I'm a brokerage, I understand that, and that's where all the listings are. And we have to try to keep them there so the consumer has their eyes on the listings. We don't want to prevent listings from being there, and we want to make sure consumers get to see everything. And I think this is sort of a goal of brokerages to try to keep money internal versus keeping it outside. So don't fall for the pocket listings. That's a nightmare that creates a complete boondoggle for everyone. And so we want to sharing. Sharing is caring, as they say. So.
Katie, it's okay. You're renting. I'm stuck with a 6% mortgage. You lose if you do in the housing market. You lose if you don't. What are you going to do? We are lucky to be able to be even in the game. Bess Friedman of Brown Harris Stevens, thank you so very much. We're going to get a check on these markets now, of course, because it's been such a strange trading day that we've been looking at. 0.25% lower on the S&P 500, and now we're getting into flat territory on the Nasdaq. We have been struggling between those gains and losses. The S&P 500 on the brink of ending lower on the week, and the 10-year yield now firmly at 4.4% once again. Katie, really interesting dynamic to close off this week.
Yeah, absolutely. Those losses lessening, but breadth still looks really bad when you take a look at the single stock level. So let's go there now with Bloomberg's cross-asset reporter Denitsa Seikova, starting with some good news.
Yeah, some good news from retail. Let's start with Levi Strauss. It's up 10% today. It's coming off the company raising its revenue outlook and expecting sales growth to outgrow tariff. That's something we've seen in the retail space. It's just all about what people say about their outlook on tariffs. We saw what happened to Gap when they projected a $300 million loss, but clearly Levi's is seeing big gains this year. It's up 25%, really one of the best performing names there. The company sees revenue rising between 1% and 2% for the current fiscal quarter. This is significantly more than what the street was expecting. People are saying that their revenue, their efforts to branch into new revenue streams, new products, is doing very well. They have this concept of head-to-toe denim lifestyle. I don't know if you're buying into it, but apparently it's doing quite well. It's
I am
cool.
very much buying into it. Jeans and cowboy boots are my favorite thing.
There you go. I am not. I'm still averse to denim, though I did buy some jeggings recently.
That's part of the trend.
Apparently I'm stuck in 2012.
I'll join you.
Let's move on, though. Let's talk about Canada Goose.
Yeah, another retailer that is doing very well. It's coming off an upgrade from Barclays, from Equal Weight, and and currently they say the risk reward for the outwear maker is more balanced. The stock is up about 4% today, but year to date it's more than 30%. Really remarkable rally there. We saw that was one of the companies that was shaken by the tariffs initially, and then a lot of people came up with the idea that it's actually relatively insulated. Canada Goose said it in their earnings call, and then it obviously emerged as one of the big winners. It sees better margins on operational improvement, highlights the firm's clean inventory. We yesterday had news about Bain Capital actually considering sale of its stake, and we saw a big rally of that news.
So interesting. Yeah, it's up 7 days in a row. It's up almost 30% in just those 7 days alone. To switch gears again, another company having a really good day, AMC.
AMC, a retail favorite, up 10% today. But if you actually zoom out, it's been a pretty tough year. That company has done so many things, jumping on the Bitcoin wagon and doing all those things to kind of restructure. But we're seeing some optimism from Wedbush, upgrading the operator from neutral to outperform. They're also seeing optimism for Cinemark. So there is a lot of optimism for those theater companies, those cinemas. They raised the rating after being neutral since 2023. They said AMC is supposed to benefit from a more consistent movie release. They're seeing growth in the UK, growth in Europe. There are all those Superman and all those box offices coming in. So there is a lot of positive sentiment. That said, the stock is down 17% year to date.
Denitsa, thank you so very much. That is Bloomberg's Denitsa Seikova. And speaking of a little dose of optimism, the latest episode of my Bloomberg original show, Bullish, is out. It focuses on the women of Wall Street. Join the 1 million people that are already watching Bullish. And here's part of an episode featuring Apollo partner Olivia Wassenaar.
You should not feel like you need to sneak out to go to a parent-teacher conference. Like, we all have them. Right? You shouldn't feel as though you've got to miss your kid's soccer game because it's 4 p.m. and it's not quite the end of the workday. Like, we've got to normalize this broader sort of parenting. So it's first of all, it's not just on the women. It's on the men as well, but it's also just part of like having a long, wonderful career is if you choose to have children, that it's not sort of a secret that you're doing these things.
It's time now for our Wall Street Week conversation. And while U.S. farm productivity and output have soared in recent decades, the country's agriculture sector is expected to record a third straight trade deficit this year. David Weston traveled to Iowa to hear from farmers about how weaker export demand is hurting their business.
A lot of farms, I understand, are actually cash negative. Are you cash positive?
I haven't ran a number to tell you today. Certainly, we know that over the last 3 years, we've seen about a 30% decline in commodity prices. I think over that same time, we've seen the 9 major crops all be underwater, so we are producing at a loss on the 9 major crops.
Gold Eagle Cooperative is an intermediary for farmers in the markets they serve. It is located on the outskirts of Eagle Grove, a short 20-minute drive up the road from Swanson's farm. We sat down there with Tom Halverson, an Iowa native himself.
I remember when my grandfather started, when I was a little kid, he had a little tractor with a harvester that would do 2, 1 on each side. He'd be going back and forth in the field like this for a couple days.
After working around the world for Goldman Sachs, he's now CEO of CoBank, which operates as a farm credit bank, counting as clients both Swanson's Farm and Gold Eagle. Halverson has a front row seat for the storm brewing over America's crop farms.
Corn, soybean, and wheat prices are meaningfully lower than they were a couple of years ago. That translates into, lower cash flows for the producers themselves. At the same time, rural Americans in general and farmers in particular are not immune from macroeconomic conditions, including inflation, for example. They are incredibly exposed to trade, buying and selling internationally. Producers have been squeezed quite dramatically over the last 12, 18, 24 months by a combination of lower commodity prices for what they sell on the one hand and significantly higher prices for the inputs.
Once seen as the supermarket of the world, America is instead finding out the hard way that the world is doing its grocery shopping elsewhere, and has been for some time. This year, the U.S. is expected to record its 3rd consecutive annual trade deficit in agriculture, something that hasn't happened in 70 years. Javier Blas covers commodities for Bloomberg Opinion.
I think that the reversal on the agricultural trade in the United States is a structural feature. I don't think it's going to go away. And there are 2 elements there that are very important. One is that the United States is importing more agricultural commodities than they used to. And the reason for that is that we like to have green beans and strawberries and other agricultural crops the whole year. We don't really want to buy them when they're in season. The other problem is that the United States is starting to export less agricultural commodities, and that is a lot in part due to Mr. Trump's trade policies.
And that was David Weston speaking with farmers in Iowa on the headwinds facing U.S. agriculture. And you can catch Wall Street Week every Friday at 6 p.m. New York time. Looking forward to tonight's episode. Now coming up next, President Trump heading to Texas in the aftermath of the last week's catastrophic floods. We're going to get the latest from Washington next. This is Bloomberg Open Interest.
to see. It was sent yesterday. They called. I think it was fairly well received, but it's what we need. So we'll see what happens.
And that was President Trump speaking to reporters at the White House earlier this morning. And the president and First Lady Melania Trump are on their way to Texas. They will be visiting with local officials and first responders after catastrophic flooding took the lives of over 120 people last week. Joining us now is Bloomberg Balance of Power co-host Kaylee Lines. And Kaylee, talk to us a little bit more about what to expect out of this trip. Of course, we've already heard from the president once today. What does the rest of the day look like?
Well, he, of course, is now en route to Kerrville, Texas, Katie, which is really the epicenter of this devastation. Not just 125 lives lost at least, but still more than 170 that are actively missing. This is still a search effort that is underway, and that's why the president has waited to take this visit until about a week after tragedy first struck, so that a presidential visit wouldn't disrupt those ongoing efforts. But we do expect him to tour some of the devastated area around Kerrville. He will be later this afternoon around 2 p.m. Eastern time participating in a roundtable with first responders and local officials. But it's coming against a backdrop of some of those very same local officials being under scrutiny as to whether or not they provided adequate warning to those in this area about the looming weather disaster. It, of course, comes as the administration has also been under scrutiny as to whether cuts to the National Weather Service had anything to do with delays in notification or potential disruptions in staffing and forecasting. So far, there is no evidence that proves that, but it also puts a focus on the president's previous commentary that he's made consistently during his second term about how he would like to see FEMA essentially unwound, that disaster response authority sent back to the states themselves. He hasn't been commenting much on that in recent days. We'll see if we get more from him on that as he makes this visit from Texas today. But that is really the kind of next leg of the story here, in addition to what's happening in Texas, how this could shape the response to natural disasters all over the country moving forward.
I was going to ask about the funding cuts as well, to your point about evidence there's not any today. But the other question I have about this is coupled with the Supreme Court decision that would lift the gates around funding cuts and layoffs really across government agencies. How does the conversation start to change?
Well, around FEMA specifically, Shonali, you've already seen kind of a change in tone from the administration, suggesting that is policy that is still under review, essentially. So we could potentially see a tone shift there. But overall, there has not been a real shift in terms of the administration's desire from a policy standpoint to pursue a smaller federal government. That's why the administration viewed that Supreme Court decision allowing them to pursue those layoffs as a real judicial victory, as they really are trying to reduce the size of the workforce. We've already had reporting out of CNN today that the State Department, effective today, could fire 1,300 people as it tries to shrink down. So that is still an ongoing effort underway, even as the DOGE has kind of faded to the back burner to a certain extent, especially now that Elon Musk has left Washington. But that is still something the administration is actively pursuing in other areas of government. It's just a question as to how it's going to affect disaster response specifically, especially in the aftermath of a tragedy such as this one.
Yeah, absolutely an urgent question there. But Kaylee, while we have you, I also want to talk about trade policy, of course. That is the concern that's working its way through equity markets right now after that missive being aimed at Canada when it comes to that 35% tariff rate. And it seems like in the letter that Trump penned to Mark Carney, he specified fentanyl. He specified non-tariff barriers as well as being the focus here.
Yeah, it's interesting that the president chose to focus on things like fentanyl in this letter, having just at the end of last month suspended for a brief period of time all trade talks with Canada over the digital services tax issue, which, of course, Canada has walked back from. So it's been very hot and cold here, but he's saying a lack of progress on fentanyl coming over the northern border, though data suggests those numbers are actually very small, is justification for raising the tariff on Canadian goods from 25% to 35%. One caveat I would note, though, Katie, is that there still will be an exception in place for goods that are compliant with the USMCA trade agreement. That is the vast majority of Canadian exports. And also administration officials have told Bloomberg that it is expected that the lower tariff rate on energy imports of around 10% is expected to remain as well. All of that said, none of this is supposed to take effect until August 1st. So there are a few weeks here of wiggle room potentially for Canada to try to work a deal. The very same, of course, can be said for all of the countries who have been on receiving ends of these tariff letters, and plenty more of them could be coming, as the president suggested to NBC News in an interview last night that he could be setting basically a blanket rate on most of our trading partners of between 15 and 20%, which of course is significantly higher than the current 10% baseline.
Higher than a lot of investors are expecting as well. Kaylee Lyons, co-host of Balance of Power. We are looking forward to later today. You are going to be speaking with White House Trade Chief Peter Navarro. That is at 5 p.m. New York time, at a critical time, of course. Markets lower today, so ending on a tough week. But coming up Monday, we're going to talk to Stuart Kaiser of Citigroup, Nancy Tengler of Laffer Tengler, Erica Najarian of UBS. This is Bloomberg Open Interest.
Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
Bloomberg Tech is live. Romaine Bostic here, Caroline and Ed on assignment on the day, but the news doesn't stop. NVIDIA CEO Jensen Huang meeting with U.S. President Trump at the White House yesterday. That's ahead of a big trip planned next week to China. Plus, we're taking a look at Tesla, which wants to bring its driverless taxis to California and Arizona. This after last month's rollout in Austin, Texas. And Crypto Week, it's upon us. We're going to discuss what to expect from a slew of crypto-focused bills in Washington with the head of the Blockchain Association. But we get a quick check here on the markets coming off what has been a relatively record week for U.S. stocks. The NASDAQ 100, though, sitting this one out down just slightly on the day, down about 0.2%. Of course, this comes just a couple of days after we had that record run by NVIDIA breaking that $4 trillion market cap threshold. Some other big movers on the week and on the day, though, of course, is in the crypto space. You take a look at Coinbase, down slightly on the day, down about 1.5%, despite the fact that it is setting up for a relatively phenomenal week. In fact, you've seen a big bid come into the fintech space this week on the back of crypto hitting fresh record highs and other pockets of the market getting a little bit of regulatory relief. SoFi Technologies up about 3%, a 4-week run there, and some of that has come at the expense of the software space. You take a look at Atlassian, representative of that team, down about 2% on the day as it heads for a slightly down week. Meanwhile, QuantumScape getting a decent bid, up 3% on the day, a 4th straight week of gains as the battery maker continues to see a bit of a delayed reaction to a big announcement that was made at the end of last month. Nevertheless, one of the big risks that you see in QuantumScape is tariffs, and that is where we're going to start the show today. An escalation in U.S. trade tensions on the week that began on Monday with that 25% tariff on goods from Japan and South Korea, 2 key sourcing regions of components for the U.S. tech sector. And of course, the week ends with higher tariffs on Brazil and on Canada, 2 key sourcing regions for the tech-heavy auto sector. Bloomberg's Kaylee Lyons, the co-host of Balance of Power, joins us right now in Washington with the latest on what I thought, Kaylee, was supposed to be the resolution of some of these trade issues.
Well, yeah, July 9th, Romaine, was the original deadline. The president, of course, officially switched that deadline to August 1st for all of the countries who have been on receiving ends of these trade letters posted on Truth Social this week. The latest, of course, as you referred to, is Canada, which as of last night is now facing down the threat of a 35% tariff on Canadian imports. That's higher than the current 25% level, though I would note that we are expecting exceptions to remain for goods compliant with the USMCA trade agreement, which is actually most exports, so that could alleviate some of the burn here, as well as for energy imports, which are expected to continue to face a tariff rate of 10%. All of this would be effective as of August 1st, although that does leave some wiggle room here for the Canadian Prime Minister, Mark Carney, to try to reach a deal with this administration. The thing is, though, for both Canada and Brazil, which you also mentioned, the justification the president is using isn't necessarily just around trade deficits and tariff and non-tariff barriers, as we saw for the more than 20 other countries who received letters. For Brazil, it's the treatment of former President Jair Bolsonaro that the president is taking issue with. And for Canada, he specifically points to the trade of fentanyl, suggesting that Canada is still allowing too much fentanyl to come over the U.S.'s northern border, although data suggests that those numbers are very minimal, at least looking back to last year's data. So it'll be interesting to see how they're able to reconcile that particular issue, as each country is going to have to try to work through things in the next few weeks, keeping in mind that the president also said in an interview with NBC News last night that for most trading partners, he's looking at applying a blanket tariff of between 15 and 20%, which of course is higher than the current 10% baseline rate that still remains in place.
Kelly Lyons down in our Washington bureau, and of course tariffs in focus, so too are non-tariff trade barriers. NVIDIA CEO Jensen Huang was at the White House yesterday, presumably to talk about U.S. technology export curbs that have limited NVIDIA's ability to sell its most advanced chips to the largest market for such chips, China. Bloomberg's Mike Shepard joins us right now to talk a little bit more about this. And I know, Mike, we don't know exactly what the two men spoke about, but given the big trip that Jensen Huang already had planned to go to China, I would have to assume that was the main topic of conversation.
Romaine, we have to assume that because China, for NVIDIA and for a lot of other American tech companies, is a major market, even with all the U.S. export curbs that are in place. And there was a concern that Jensen Huang has articulated publicly and no doubt spelled out in private with President Donald Trump at the White House yesterday, that NVIDIA and other American companies risk losing ground in this key market for semiconductors. China, it's not only the world's second largest economy, it is the world's largest buyer of computer chips. And one of the biggest concerns that they have is that China will be able to gain ground in the area of artificial intelligence if the U.S. maintains this regime of strict export curbs. We did see some relief from that during the president's trip to the Middle East when they began to roll back some Biden-era curbs governing sales of advanced chips to a lot of other countries. And this is a measure aimed at keeping those chips from leaking to China, but that still may not be enough. Jensen Huang argues that we need to be able to sell into China, and that is to perhaps keep its top Chinese rival, Huawei Technologies, from gaining ground in this area of AI chips from it.
Yeah, I am curious, though, Mike. I mean, how much do we know about the support that Trump and the White House overall is willing to give to, if not just NVIDIA specifically, but overall to the U.S. chip sector to address some of those issues and address some of that competition?
Well, that's a great question, and it's one that chip industry executives and leaders here in Washington that we've met with and talked to have really been mulling, and they don't know the answer because you're also swimming against a very strong anti-China tide here in the nation's capital. Over the years, so much of the rhetoric has been driven on the national security side that, look, if you sell advanced technology to China, there's a great risk that there will be a dual use for it, not just in the commercial sector, but in the military and national security sphere as well. And that could put U.S. security at risk if China is able to deploy these advanced technologies, especially in the area of artificial intelligence in that way. Hence all these export curbs. And yet what Jensen Huang and others are arguing is that, look, around the world, if the American tech stack is to prevail, we need to be able to sell our chips in China and sell them more broadly around the world without fear of restriction. We don't have to sell the most advanced versions of our semiconductors and GPUs to those countries, but we still should be selling more than we are able to right now so that we can assure that the U.S. has that toehold. And look, the NVIDIA CEO and Donald Trump really have forged a rapport. Jensen Huang is becoming a more frequent visitor here to the nation's capital, Romaine. And during this Saudi visit that I mentioned, Donald Trump looked in the audience for Jensen Huang and even called him my friend Jensen. So you can expect that there was a warm discussion at the White House yesterday, Romaine.
All right, Mike Shepard, who of course covers this all from us in Washington, as we keep an eye on Jensen Huang as he embarks on that trip next week to China. When we come back here on Bloomberg Tech, we're going to focus in on Apple as it tries to line up its slate of products for 2026, what to expect, and more importantly, will consumers buy it? This is Bloomberg Tech. Apple is planning a slew of new products that it plans to introduce in the first half of 2026. Now, that includes a new low-end iPhone, new iPads, and upgraded Macs. That's the reporting from Mark Gurman, and he joins us right now to talk a little bit more about that. And Mark, let's first start off with exactly what is the sort of complexion of this lineup, and why are they taking that particular approach?
Yeah, Romain, thank you so much for having me. So Apple typically launches a bunch of new products in the fall, and that's going to happen again this year with some twists. So we'll get the usual new iPhone, the 17 line, the usual new Apple Watches, but there'll be a couple other bells and whistles that they usually don't do this time of year. One is an upgraded version of the iPad Pro. Two is an upgraded version of the Vision Pro. That's their new headset. And then looking towards the first half of 2026, usually they release new MacBook Pros with new high-end processors in the fall. This time around, at least currently, again, it remains fluid, they're aiming for early next year. So first half of next year, you'll get new MacBook Pros, you'll get a new Mac external monitor, you'll get new low-end iPads, you'll get new mid-tier iPad Airs, and of course, as you mentioned, the iPhone 17e, which indicates a strategy change for Apple. Now, their entry-level, their cheapest iPhone, is on track to be updated on an annual cadence instead of every few years.
I am curious, Mark, about sort of other products that aren't necessarily just updates of existing ones, whether we're talking about the wearable strategy, the smart home strategy, and obviously any insight that you might have into any sort of developments on the AI front.
Just to put a highlighter on your point, Romain, because I think this is exactly right. None of these products are revolutionary. None of these products are redesigned. None of these products are wholly new. I would barely characterize many of these as iterative. They're basically what they call in the industry a chip and chip, which means you replace the processor in the device with a newer generation component. And as we know, the laws of physics are very apparent with Apple these days. The 50%, 75%, 100% gains that you used to get on an annual basis for new Apple chips, those days are 5 years in the rearview mirror. So in terms of something wholly new, they were supposed to release a smart home hub, basically a home pod with a display, very AI heavy. This past March, they had to delay it as part of the delays to their new Siri features, a feature called App Intense, which allows you to control your device very precisely with voice commands. Because those software and AI features were delayed, they obviously also had to postpone the hardware. I'm told that hardware is now on track for the first half of next year to be aligned with them finally being able to ship those upgraded voice commands features.
All right. Well, maybe, I guess, the rollout of these new iterations or whatever we want to call them, Mark, maybe it provides a little more consistency on the revenue front for investors, but for consumers, maybe not necessarily the most exciting thing out there. Mark Gurman, of course, will keep tabs on that. There is some excitement, though, in other parts of the tech space, and that, of course, involves AI and robots, the combination of those two. The AI development platform Hugging Face has launched a new mini robot. It calls it Richie, and users will be able to program the device using the company's open source machine learning platform to enable it to do, well, I guess whatever anyone can think of. Here to discuss is Thomas Wolfe. He's the co-founder and chief scientist over at Hugging Face. All right, Tom, let's talk first about the general idea behind what Richie is supposed to do. What is the main benefit or the main added value that someone buying this is going to see right out of the box?
So I think there will be a lot of things. It's an AI robot that's designed to be a human-robot interaction platform. So it can move its head, it can move antenna, it can basically share a lot of emotion with the user, but it also has sensor. It has a camera, it has a microphone, it has a speech, audio speakers built in. And so our general idea is that you can plug this model with, all the new AI models we've seen right now, which can generate, speech, which can digest image, which can understand what you say. And we think there is a need right now for a very accessible platform for people to start building this human-robot interaction.
So as people sort of get this device, and the idea, obviously, of it being open source, being, I guess, set up in a way where you kind of have that crowdsource ability to tinker with this thing and make it better, what do you think would be the advancements that we would see most soonest, I should say, most immediately?
So So you have to picture this as a device that can be used in many, many ways. So it will ship as a kit, a little bit like Lego. You can build it. You can build it with your kids, with your family and friends, and then it will be provided with a couple of apps already. And I think one specificity as well is that you can run this app locally, so you don't have to actually send data in the cloud if you want. You can also use it, but you don't have to. And so it will ship with a couple of apps. We've already been developing internally fun games where the AI interact with you in a fun way. But what we expect and what we're really excited about is to see the community create new apps, right? So we'll provide a SDK that make it very easy to make new behavior. You know, I don't know, if you're cooking, you put it next to you, and maybe you want to design it as a little cook assistant that comments your cooking and maybe give you tips for your recipes. And then once you build this, you actually want to share with the community, and that's where the power of the Hugging Face service is crazy, because you can just actually upload this, and it's that automatically became accessible to all the other robots. Another user can point on your robots cook space and use it locally.
I am curious, with regards to robotics, why don't you think we've seen more either open source or open weighted business models in this space?
It's a good question. I think a lot of people have been focusing on these very expensive humanoid robots, right? And the price tag for this is obviously more in the $80,000, right? And so here it doesn't make a lot of sense, I think, to do them open source right now. But when you picture something much simple like Richie Mini, which still has like 10 motors in it and it can do quite a lot of things, but it cannot walk, for instance, then you're making it open source, kind of value much more the type of behaviors you can build and how, you know, the community can use it, and the community that can actually tweak, play with it is much wider than humanoid robots. So I think that's one reason we're maybe the first to tackle this segment.
I know this product's just getting off the ground here. This is primarily designed and made in the United States. And I am curious that as you expand this product and any sort of descendant products out of it, how are you going to navigate, let's just say, a somewhat topsy-turvy trade and tariff environment that has sort of disrupted where you source things and even to some extent where you can sell things?
That's a good question. We've been surprised, actually, because obviously the US market was our first market, and I think we are nearing 1 million revenue on this product already after just a couple of days, and I think 60% roughly of it is out of the US. But you see, 40% is from the rest of the world, right? With Europe first, but then also Asia and South America leading after that. And so I think for us it will be interesting to see how we can source some of these parts more locally and see if we can actually maybe build this robot in various places of the world and take advantage of the simplicity in a way of some of its design.
All right, Thomas. Certainly exciting times we're living in right now. Thomas Wolf there, of course, the co-founder of Hugging Face, and you saw it there on the screen, that new robot that just debuted a couple of weeks ago, Richie. When we come back, we're going to focus in on Amazon and Amazon Prime Days, the 4-day shopping event, finishing strong after weaker than an expected sales start. We're going to have that discussion after the break. This is Bloomberg Tech.